In this video, let's take a deep dive into Bogleheads Three Fund Portfolio. This portfolio has been pioneered by John Bogle, the founder of the Vanguard Group. Later, many other researchers refined the Bogleheads Three Fund Portfolio, and among them is Taylor Larimore. Taylor wrote a terrific book on Bogleheads Three Fund Portfolio, and it's a great starting point. I linked it below. John Bogle is a known American investor and philanthropist, but he's most renowned for popularizing low-cost index funds. After facing much skepticism, index funds took the world of personal finance by storm. John Bogle learned the perils of stock markets early on. His family was well off, but lost it all during the Great Depression of 1932, as many did.
I was born into a family that had considerable wealth, but it all vanished, literally went to zero. By about 1932 or 1933. So we were on our own, and we had to make do with what we could. We had to begin, as we got a little bit older, had to earn what we, if you wanted something, you went out and earned the money to get it.
It was perfect in hindsight. It taught John Bogle to take responsibility and make a living on his own at an early age. Fast forward to the 1970s, after graduating from the Princeton University and a career in investing. John Bogle was at a crossroads. He was ousted from his chairman position at Wellington Fund in 1974. Left on the sidelines, John Bogle decided to pursue what he always wanted, and that was index fund investing.
About a year, I decided to get into investment management by starting the world's first index fund, which actually had its genesis in my Princeton senior thesis, where I said mutual funds can make no claim to superiority over the market averages. I think that's a direct quote.
And the rest is history. John Bogle founded the Vanguard Group in 1974, and a few years later he released his first mutual fund based on index investing to the general public. The fund bore the name of the first index investment trust, and later the fund was renamed into the Vanguard 500 Index Fund, and its goal was to track S&P 500. And index investing condensed pretty much everything that John Bogle learned over the years, which was simplicity and thrift.
The values of Vanguard, a company I created in 1974 out of a corporate mess, which are, in a sense, the old Quaker values of simplicity and thrift. And that's I'm not a Quaker, but that's the life we lived. Simplicity. It was easy for me to understand what was going on. And thrift, because we had to have it. And the Vanguard, you could say. And when you look at indexing, and it's certainly simplicity. When you look at thrift, we created what is still the only mutual organization, mutual financial organization, mutual company owned by the fund shareholders and not some outside manager.
Thrift is one of the cornerstones of the Vanguard Group, and its corporate structure is such that Vanguard funds are effectively its shareholders. So take, for example, any other fund manager like BlackRock or Fidelity. Its customers and shareholders are usually two different groups. For Vanguard, they are one and the same, so the company's goal is to maximize value for its shareholders, who happen to be you and me, who put our money into Vanguard funds. So for over 4 or 5 decades, Vanguard has been relentlessly lowering its fees. And it's a big headache for companies like BlackRock, Fidelity, or Schwab. At the core of Bogleheads Three Fund Portfolio are these 11 principles. These principles prioritize regular saving, diversification, and sticking to an investment plan. Staying the course is key regardless of what happens in the markets. As a result, Bogleheads portfolio has produced outstanding risk-adjusted returns. They are far greater than those achieved by the average investor. Let's start with how Bogleheads Three Fund Portfolio works. This portfolio uses only 2 basic asset classes. They are stocks and bonds. Stocks are further divided into domestic equities and international equities. Thus, you only need these 3 funds to construct the traditional Bogleheads portfolio. they are a total market index fund focusing on US stocks, then you need a total international stock market index fund for foreign exposure. Finally, you would add a total bond market index fund with a focus on the US. Let's understand what I mean by total market. Take Vanguard Total Stock Market Index ETF or VTI. The fund buys almost all stocks that trade on major US exchanges. VTI weights each equity by its market capitalization. The result is that the fund tracks the entire stock market in the US. And so to beat VTI literally means that you have to beat the market. And the same logic applies to total international stock and bond market funds. As we see, foreign bonds are missing here. A typical Bogleheads Three Fund Portfolio does not include international bonds. If you go to the Bogleheads forum, there's a lot of debate on this topic. My conclusion is that it won't hurt. Plus, Vanguard does include foreign bonds in its target date funds. It's about 1/3 of all bond allocation. At the end of the day, it will be up to you to decide. The ETF ticker for this fund is BNDX, with corresponding mutual funds names in this table. Here's another interesting observation. Vanguard Total Bond Market Fund includes only investment-grade securities. Why is that? Moody's, Fitch, and other credit rating agencies, they rate bonds and assign different ratings to them, right? So those bonds that come with the lowest risk of bankruptcy typically get investment-grade ratings. And the remainder is known as high-yield bonds or junk bonds. Vanguard researched before investment-grade versus high-yield bonds, and they came to the conclusion that high-yield bonds tend to behave like stocks. The goal of having bonds in our three-fund portfolio is to have uncorrelated returns. In other words, we want bonds in our portfolio to behave differently from stocks. So it makes perfect sense why you would not want high-yield bonds and you want investment-grade bonds in your portfolio. One typical allocation in the Bogleheads Three Fund Portfolio is 60% to stocks and 40% to bonds. The 60% in stocks is further broken down into 42% in domestic stocks and 18% in foreign equities. This particular allocation looks a whole lot like a typical balanced fund. The allocation between bonds and stocks is the most important decision you will make. We will come back to it in a second. But isn't it amazing? You only need 3 funds. Its simplicity is shocking. But don't get fooled by it. There's a lot of thought that went into it. And this portfolio stands on the shoulders of giants. Bogleheads Three Fund Portfolio is a prime example of a lazy portfolio. It's very easy to maintain and rebalance. And it can free up lots of money and time that you can spend on constructing portfolios. And this effort and money spent does not necessarily always justify the end result. So let's address the why. Why would you have Bogleheads only 3 fund portfolio to manage your retirement nest egg? Taylor Larimore in his book gave 20 reasons for that. I want to focus on top 5 that I think make Bogleheads Three Fund Portfolio a smashing success. The first reason has to do with its ability to generate above average returns. S&P Global publishes this periodic report. It shows the percentage of all large cap funds that underperformed the S&P 500. Over the last 15 years, almost 90% of them underperformed the S&P 500. That's a staggering number. The problem gets worse. Many underperforming mutual funds tend to disappear due to liquidation. In a sense, the data suffers even more from the survivorship bias. Back in 2013, Eric Ferry wrote a paper where he did a study of 5,000 actively managed mutual funds. He compared their performance to the 3 index funds in our Bogleheads portfolio. His conclusion was this: active funds face 99% probability of underperforming all index fund portfolios over their lifetime. The second reason is one of the best diversification that this portfolio provides. And this is a saying that diversification is the only free lunch in investing. Bogleheads Three Fund Portfolio spreads its bets across different sectors and stocks, and it reflects basically the market, which as it turns out, not that easy to beat long term. True, the sector allocations may get a bit concentrated like it did recently. For instance, Vanguard Total Stock Market Index Fund has 30% exposure to tech. But this reflects where money and profits go based on market cap. As new winners emerge in other sectors, VTI readjusts and channels funds there. By its design, total market index funds amplify strong returns and suppress weak ones. And this leads me to reason number 3, which is no individual stock risk. Unlike mutual funds, individual stocks can go to zero. S&P 500 and total market index funds regularly change their allocations to stocks. Or sometimes they can even drop them completely. Since 2015, S&P 500 dropped 180 stocks. And that's a third of the entire index just over the course of 10 years. And in 2007, on the 50th anniversary of the index, guess how many stocks are still there out of the original 500? 86. That's right, only 86. The remainder got dropped due to underperformance, mergers, or bankruptcies. By holding a diversified basket of stocks or bonds, the risk of ruin goes down to virtually zero. As John Bogle famously said, I favor the all-market index fund as the best choice for most investors. Don't look for the needle, buy the haystack. The fourth main reason is the benefit of low cost. Among all the factors that can predict the success of a given fund, low cost stands out. In other words, the cheaper the fund, the higher the probability that it will generate above the average returns. Total market index funds are some of the cheapest on the market, and with Bogleheads Three Fund Portfolio, you won't have to opt for pricey funds, and you won't even need financial advisors. Of course, advisors have their role, and there are many good ones out there. But for the majority of people, the three-fund portfolio will do wonders. It will put more money into your pocket and not in someone else. Here's some words of wisdom from John Bogle on low-cost investing.
For God's sake, don't let the miracle of long-term compounding of return be overwhelmed by the tyranny of the long-term compounding of costs.
The fifth reason for Bogleheads portfolio is its low maintenance and simplicity. Rebalancing is very easy, and you won't have to worry about Nvidia earnings or stock market fluctuations. You can tune out all that noise and not worry about it. And also you will have a good night's sleep knowing that long term you will be fine. And as a bonus, you will have more time to enjoy your life and not check your brokerage account balance every hour. Of course, there are many more reasons in favor of Bogleheads Three Fund Portfolio. Taylor Larimore lists them all in his book. Check it out, it was one of the best reads that I've done on investing. To get started with the Bogleheads Three Fund Portfolio, here are the steps to follow. First, decide which funds suit your needs best. Here's what the conventional Bogleheads Three Fund Portfolio will look like if you go with Vanguard. First is the US Total Stock Market Fund. Then are the International Total Stock Market Fund and Total Bond Market Fund. As we saw, there is no exposure to international bonds with these three funds. You'll have to decide whether to have it or not. Either way is fine. The second step is to decide the allocation between stocks and bonds. And this is going to be the most important decision that you will make. The key thing to remember here is the risk-reward relationship. Higher expected returns almost always come with a higher risk. Let's take a look at this chart from Vanguard that illustrates this concept better than any words can describe it. The data in this chart spans from 1926 to 2024. Let's take this first bar, which shows best, worst, and average returns for a given allocation. It shows 100% allocation to bonds. On average, bonds produced 5% annual returns. This average return did not always happen. The worst year when bonds tanked came with 13.1% loss. But in the best year, bonds experienced a whopping almost 33% gain. Now let's compare this bar with the opposite of the spectrum if you had 100% allocation to stocks. 100% allocation to stocks produced a much higher annual average return of almost 11%. That's 2 times more than bonds, but that's an average. During the worst year, stocks experienced a drawdown of 43%. That's 3 times more than for bonds. At the same time, stocks shined in their best year with a whopping 54% gain. That's over 1.5 times more than for bonds. All other bars in this chart show how your returns change depending on your allocation. Increasing stock allocation above 60% comes at a higher risk. The bar expands with more variability in returns. So no wonder many financial advisors recommend 40% allocation to bonds and 60% to stocks. That's kind of like a default and safe option out there. So we see, if you want a higher returns, you almost always must accept a higher risk. The variability of returns start to go up as you allocate more to riskier assets like stocks. And another thing to keep in mind is that bear markets can last more than 1 year. For instance, after peaking, it took the S&P 500 over 4 years to recover to its previous high. A problem with this prolonged recovery is, what if you had just retired in those years? Then you'll have to sell your stock at low prices for a long time. That's something called sequence of returns risk. The worst outcome is that your nest egg gets depleted earlier than expected. The rule of thumb says that your allocation to bonds should be equal to your age. So, for example, if I'm 40 years old, then my bond allocation should be about 40%. But for some people, this rule of thumb could be too rigid or conservative. And things will depend on many other factors like your planned retirement date, your amount of capital, as well as your risk profile and the risk tolerance. You will have to assess all these things together. For instance, what if you are very likely to have a very large amount of capital? Right? It's a good thing to have. And this large amount of capital will be more than your spending needs will require. So in that case, well, you may go after more aggressive allocation to stocks, so you can allocate most to stocks, to bonds, than what some of these rules of thumb dictate. Vanguard has a free online asset allocation tool. There they ask a series of questions and they will try to assess your risk profile, your planned retirement date, as well as your age. And based on your answers, they will spit out a result suggesting the split in allocation between bonds and stocks. One thing that this tool will not suggest is the allocation to foreign stocks. If you go to Bogleheads forum, it's a hot and debated topic, but the consensus is such that it's leaning towards having some foreign exposure. And that's what Vanguard recommends too. I have another separate video on just international stock exposure and why have it. And it all boils down to better diversification outcomes in retirement. Bogleheads also debate how much to allocate to international stocks. And Taylor Larimore and John Bogle think that 20% exposure of all stocks is enough to allocate to foreign stocks. But Vanguard thinks that maybe 40% is better, and that's what they have in their target date funds. At the end of the day, it will be up to you to decide. So this is the final portfolio with sample allocations of 60% to stocks and 40% to bonds. 80% of all stock exposure goes to US stocks, while 20% goes to foreign stocks. Notice how I don't have exposure to international bonds. Vanguard recommends 30% exposure to foreign bonds based on their target date funds. That's a good starting point, but again, it's not required. You can decide later for yourself. And by the way, it doesn't have to be Vanguard. There are other funds by Fidelity or iShares that do the same job. Just make sure to compare expense ratios among the funds to make sure that you choose the best option. Tax-deferred retirement accounts are some of the best places to keep your Bogleheads Three Fund Portfolio. But I realize that maybe it's not always possible. So as far as that, then stock funds are very tax efficient and they're quite suitable for taxable accounts. But as far as bond funds, they are not. They are not tax efficient, and maybe you should allocate as much as possible to your tax-deferred accounts when it comes to bond funds. After you put in place your Bogleheads Three Fund Portfolio, congratulations. And the next important step is to stay the course. Occasional rebalancing will be necessary to make sure that your allocations to stocks and bonds is properly maintained. But that will not be easy. And here's why, given two scenarios. The first one comes down to bull markets. When the stocks are doing extremely well, you'll be tempted to allocate more to stocks, or at least let them ride. The thing is that small deviations from your allocation, your target allocation, here and there are fine, but if they exceed 10%, you will need to rebalance. And some people suggest a lower threshold around 5%. For instance, suppose stocks did great in the last year, bonds held steady and went nowhere. Your stock funds outgrew their target 60% allocation and account for 70% of your portfolio now. In this case, you must rebalance. There are two ways to go about it. First, you can sell stock funds and buy your bond fund. Or, if you're far from your retirement and still accumulating, you can stop putting money into stocks. Instead, put new money in bonds. The same thing goes for bear markets. When the stocks are tanking, you will be tempted to sell your stocks. Please, don't do it. Don't. That's the worst thing that you can do. And the best outcome for you is to actually bite the bullet and sell your bonds and allocate more to your stocks so that your allocation target is maintained. These reallocation adjustments are like buying low and selling high. And that's gonna be very difficult. Here's some words of wisdom from John Bogle on this. Stay the course. No matter what happens, stick to your program. I've said stay the course 1,000 times and I meant it every time. It's the most important single piece of investment wisdom I can give to you. It takes guts and lots of intelligence to stay the course. And that's what I discovered over all these years on my own mistakes. But why learn on your own mistakes? Millions of investors discovered the wisdom of John Bogle's words and follow his advice. And I hope you will too. And that's it for this video. I hope you found it useful and it will help you to make a better retirement planning. John Bogle's approach to investing is very simple, but based on sound research and common sense.
When you're talking to your students, tell them never, never, never to forget the value of common sense. Well, I exhumed the phrase. I don't think anybody used to use it, but they do a little bit more now. Occam's razor, Sir William of Ockham over in England, I think 1400s. If there are multiple solutions to a problem, choose the simplest one.
In the future, guys, I'll have more videos on John Bogle and Boglehead's approach to investing. So stay tuned for that and subscribe to my channel for more content in the future. All the best!